Hey, what's up guys? Welcome back to the channel. Welcome back to another video. If you're stopping by the channel for the first time, please consider subscribing to my channel. And while you're at it, smash that like button for me. I really would appreciate it. If you want 5 free stocks, Webull is going to give you 5 free stocks when you open up a new Webull brokerage account. Put at least 1 penny in an account. They're going to give you 5 free stocks valued up to $9,600. So after this video, I want you guys to go down to the description box of the video. Click on that Webull link. Open up your new Webull account today. Go get that free stock. Go get that free money. Well, guys, the Federal Reserve has announced they're going to be increasing interest rates by 50 basis points. They're increasing interest rates because they're trying to bring down inflation. See, inflation is somewhere in that 7 to 7.5% right now. And you may ask yourself, what is inflation? Well, in my opinion, inflation is the overall increase, right, in price of the goods and services in our economy. So when prices go up and the money that we have to buy those goods and services that just went up in price, when that money goes down in value, that causes inflation. Now, a couple of things that can contribute to prices going up and inflation going up is low interest rates. That's one way. That's one reason, low interest rates. And I'll touch on that in a second. The other thing is increase in wages, right? When people are making more money. Why? Because when people make more money, they do what? They spend more money, right? So yeah, wages, higher wages can contribute to inflation. Also, supply chain issues can contribute to inflation, right? Why? Because when people are making more money, interest rates are low, guess what? And we have supply chain issues. That means those goods and services are going to go up in price because there's more demand for them and we got limited supply. So that's where the supply chain issue can come into play and affect inflation. So the feds have decided, look, we raised interest rates by 25 basis points back in March of 2022. And we saw a little bit of movement, but we want more movement. We want inflation to start coming down quicker. So they decided to increase interest rates. And when I say interest rates, I'm really talking about the Fed funds rate, which is the rate that banks borrow money from each other, right? So they're going to increase that by another 50 basis points. But it also affects other areas of interest rates. One is mortgage rates. Remember back in March when they moved interest rates by 25 basis points, the Fed moved interest rates by 25 basis points. Mortgage, 30-year fixed residential mortgage rates went up as well. A year ago, you could have locked in a 30-year fixed residential mortgage rate in that 2.5% to 3% range for 30 years. Now, fast forward a year later, you're in that 5% range for a fixed 30-year residential mortgage loan rate, that's the way it is, guys. So how does that affect residential real estate? Well, I still think residential real estate prices are going to continue to slightly go up. Why? Because we still have what? A supply issue. Right? We got still a lot of demand. Even though mortgage rates are rising, we still have quite a bit of demand for residential real estate. When I'm talking about residential real estate, I'm talking about homes, right? Primary residences. People are still trying to find properties to move into and live in, but there's still not enough supply on the market. So even though rates are going up, you still see real estate prices going up because there is a supply issue. We don't have enough supply. At some point, though, I think if rates continue to rise, I think that's going to start pricing some people out of being able to go out and buy a new home or sell their existing home and maybe trade up to another home. And the reason being is at some point when rates go too high, they just start pricing people out of being able to afford to buy a residential piece of real estate or a home or a condo or a townhouse. It's just harder, right? Because if a year ago I was looking at a $400,000 house and I qualified based on a 2.5%, 3% fixed interest rate for 30 years, but for some reason I decided not to go through with it. Now I come back a year later and I'm looking at that same $400,000 house, but now the interest rate for my 30-year fixed mortgage is 5%, 5.5%. Guys, that's a big jump in interest rate, which directly affects that person's monthly mortgage payment, right? So that can price a lot of people out of being able to buy their first home or upgrade a home or downgrade a home. It may price people out because of higher interest rates, which have a direct effect on your monthly mortgage payment. So how does it affect the stock market? A lot of times it affects the stock market because the stock market is made up of what? Companies, right? The stock market is made up of companies. And when companies can borrow money cheap, especially growth companies, right? Companies that need money in order to continue growing, right? Those companies struggle when rates go up. Why? Because now they can't borrow money cheaply anymore, right? So what they tend to do is they stop borrowing and they stop growing. They stop because they can't borrow the money cheaply. It doesn't make sense. They rather just wait until they can borrow the money cheaply and then they can resume growing again. So, and that's my opinion, guys. You know, the stock market is made up of companies. When companies can borrow money cheap to expand, do R&D, they do it. They borrow that money cheaply. They expand, they create more products, they make more money, and they're more profitable. But when money gets too expensive because rates go up, then it's not, it doesn't make any good, smart business sense to borrow higher interest rate money and you don't believe you can make more money off of that high interest rate money. You just leave it alone. So I think that's what hurts the stock market is when companies can't borrow and expand, they tend to stagnate or pull back. Therefore, they're not growing. Therefore, the per share stock price is not growing. So investors tend to start moving their money away from the stock market and putting it in other places where they can get a higher return. Also, when interest rates go up, banks increase their interest rates on their money market savings accounts, CDs. And for retail investors like you and myself, if I can get a 2% rate in a money market account at my bank and my principal is safe and protected and I'm going to get a 2% yield on it, I may say, well, hey, man, since the stock market is so volatile, up and down, let me take my money out of there and I'm going to put my money in safety at the bank and get my 2% return until this stock market works itself out and gets back on a more stable basis where I can predict a little bit how much money I can make. Right now, it's so volatile, too much risk. Let me take my money out. So that's what happens to the stock market when rates go up is companies can't borrow cheaply anymore, so they don't grow and expand. And then retail borrowers like you and I, we just say, the heck with this volatility stuff. Let me pull my money and put it over here in a CD at my local bank, get me 2.5% return on that money, and I'm happy until the stock market settles itself out. And then the third one is businesses. I mentioned publicly traded businesses that are in the stock market, but we also have private businesses who also suffer. Why? Because our small private businesses, just like I have a small private business, you may have a small private business. When we try now to go to the bank to borrow money, it's super expensive. Why? Because rates are up. So we can't really borrow that money too expensively and then think we're going to have enough revenue minus our expenses. We're going to have enough net profit for it to make sense. So a lot of times, even private companies, small companies, don't borrow money and they don't grow either. So it can also affect small businesses. And you gotta understand, in America, small businesses make up the majority of businesses, right? Not the businesses you see, in the stock market. No, it's small businesses, right? Less than 500 employees make up the majority of the businesses in the United States. So there you go, man. That's where inflation can continue to hurt us, right? Because if we don't get that inflation down, it keeps rising, then yeah, businesses are not going to borrow any money. The stock market is not going to do well. It's going to continue to be volatile. We'll continue to stay in a bear market. And these are all my opinions, guys. You can go out there and do your own research, but I believe with the Feds moving these rates up 50 basis points, a good thing, because we need to get inflation down, right? We got to get inflation down. We got to slow down spending. See, people are spending too much. And when they raise those interest rates, it forces people to stop spending, right? It brings prices down, especially if we can get the supply chain issues worked out in connection with lowering inflation. Then we can get our economy back on an even keel with inflation around 2.5%, which is healthy for our economy, right? That's where we want to be. So as investors, in my opinion, even though the stock market is volatile, even though companies are not growing as fast, at least growth companies, I still say this is an opportunity for us, though, to go ahead and purchase and buy our favorite companies and our favorite ETFs. Why? Because they're on sale. At some point, the stock market turns itself around and those companies start borrowing again. Things start looking good again. They start growing again. And that's where we'll increase our net worth when those stock prices start going back up, right? With real estate, I'm on the sideline. Now, if you don't want to stay on the sideline with real estate, only thing I can tell you is buy location, buy location, buy location. That's how you protect yourself. See, in good or bad times, people still have the desire to live in certain places, and they're going to make it happen. So buy location. If you have to buy real estate right now, buy location, because that's what's going to protect you and protect your money in real estate right now. Well, guys, drop me some comments down in the comment box and let me know what you think about inflation. Let me know what you think about the Federal Reserve increasing interest rates potentially by 50 to 75 basis points in the month of May. And then let me know how you're going to handle that. Are you going to stay in the stock market, continue dollar cost averaging in, buying the dip, or are you going to be taking your money out and putting it in your savings account or your money market at your local bank? If you want those 5 free stocks from Webull, click on my link down below in the description box. Open up that new Webull account today. Get them 5 free stocks and get that free money, guys. If you're stopping by the channel for the first time, please consider subscribing, share the video, smash the like button. Thoughts become things. If you can see it in your mind, you can hold it in your hand. Keep chasing your greatness, guys. Never stop believing in yourself. And I'm going to catch you on the next video. Bye. Today's video is sponsored by my company, RF Financial Consulting. And in my company, I work with individuals just like you through financial mentoring and coaching sessions. And in those 1-hour sessions, we talk about strategies to help you get to your financial freedom, whether it be through real estate investing, stock market investing, creating additional streams of income, credit card arbitrage, or starting and growing a business. If that's something that you might be interested in, there's an email address in the description box of the video. Send me an email and let's discuss if I'm the right fit for you.